Welcome, everybody. It's a real pleasure to be here today with you and to chair the morning of the AVCA VC Summit in Nairobi. For those I haven't met, I'm Julie Andraus. I am managing partner of Jungo Capital. We are a VC fund in Senegal. We invest in impact-driven technology startups at seed stage across Francophone Africa. So before founding Jungo Capital, I spent over a decade on capital markets in Paris and New York. And since 2019, I've been actively investing on the continent in startups. So what excites me the most today is the depth and maturity of the conversations we're now having as an ecosystem. We are at a moment where African venture capital is evolving, and I think that this morning's sessions capture that shift very well. So we're going to start by taking a step back and asking some fundamental questions about the model itself. So a VC model that's largely imported. And the first panelist will explore where expectations have diverged from outcomes, what has worked, what hasn't, and what may need to change as we look forward. This discussion will be moderated by Leo Batlov from DLA Piper, who will be joined by an outstanding group of speakers. And then in our second panel, we'll move into understanding LP dynamics. Our panelists are going to discuss how African VC remains largely funded by international capital, which raises important questions around local participation, institutional constraints, and how to build a more balanced capital base going forward. And this second panel will be moderated by Juliette Monroe from FSD Africa, and will be joined by a great panelist as well. So without further ado, please give a round of applause for the first panelist.
Oh. I thought so. Thank you.
Yeah.
We can start, right? Can you hear me? Yeah. Okay. Hi, my name is Leo, and I'm a co-head of venture capital practice at DLA Piper. It's a law firm to deal globally. I kind of cover the continent, along with other things. Today, we're going to talk about whether the VC model that we have in place in Africa, how is this imported from the United States, Europe, other markets, how it works, doesn't work. And we have today, and I'll go, investors and LPs. I'll ask them to introduce themselves and say a few words about their company and themselves. Fatoumata, they're with Jungo Capital, Tidjane with Partech, Mohammed with AVCA, and Sapna with Novastar. So if you could just briefly introduce yourself and say a couple of things about yourself, your company.
Good morning, everyone. I'm Fatoumata Bâ. I'm the founder and executive chair of Jungo Capital, which is an early-stage venture capital fund with roughly $90 million asset under management and based between Abidjan, Lagos, Tunisia, and Paris. We invest between 50K and 5 million in tech-enabled startups that leverage actually technology to leapfrog development in Africa. And I'm originally from Senegal, as you can hear.
Tidjane?
We should not be telling you we're all Senegalese today. I'm Tidjane from Senegal. I'm a general partner at Partech. And I've been doing this for a few years now, so I cannot pretend, I can no longer pretend that I don't know what investment is. But I'm an engineer, not an investor.
Good morning, everyone. I am not Boris, and it's very difficult to follow someone like him. I'm Mohammed. I'm head of the global venture capital team at IFC. We are the largest investor in emerging markets. Our role really is to help develop the ecosystem by investing directly in startups as well as in funds.
Sapna.
Thank you. Very nice to meet all of you. I am Sapna Shah, partner at Novastar Ventures. I'm based in Nairobi, so we have one Kenyan on the panel. And we are a VC fund that is spanning East Africa, West Africa, North Africa, and South Africa now. We're on our third fund. We're one of the early institutional VC funds at scale on the continent. And as Tidjane, you said, we've seen a lot. So look forward to sharing some of those learnings with you today.
Okay, thank you very much. So today the topic is import VC model from the United States, how well and not well it works in Africa, why, and what we, the four of us, five including, can do to change it and to make it work better. So the question is, so what's the VC model? We should be all familiar with that if we're sitting in this room. It's basically you take the money from the LPs, you deploy it and invest into high growth tech companies, hoping they go gangbusters. Some of them will die, but you still show returns above average. Give it back, sell the companies, they go to IPO, whatever. Give it back to the investors. Happy investors give you money back, and the circle of life continues. So that's the happy story. So is that the question number one? And I'll ask Tidjane if, since you brought it up on the sidelines, do we have that model here? Have we adopted that? Is that the model we're running in Africa? Yeah.
I'm on the spot.
Yeah.
So, again, let's make this interesting. We are between us in the room. I become a bit sensitive when we call it out as an imported model. Isn't it imported everywhere? I mean, after Sequoia, everybody else imported it. But I think what I would add to your definition is VC capital is the risk-tolerant capital that is necessary to drive innovation everywhere. And it is the same role it is playing to be needed everywhere. And I become emotional about it because what happens when you don't have it is tragic. It is highly talented entrepreneurs who take 5 years to do what they should do in 6 months. So that is not a luxury. It is something we need. And it is something that VC is, really good at doing. So we should not consider it as something, sort of some luxury we're putting on the ecosystem. My first point. My second point is, it was adapted from day one. We never tried to make it look like VC in the Silicon Valley. We deployed much smaller amount on very different terms in companies that were not software only, were highly operation intensive. Mm-hmm. It was always adapted. I think the underlying question that we keep all asking is it working when we talk about the model being imported? And of course, that's still up for debate. And let's have that fight here. But I will quote 2 people I admire, one a celebrity and one a bit less. So Chimamanda Adichie said, let's not be trapped in a single narrative. So let's not make this VC story about one narrative. There is a lot of things going on in the ecosystem, good and bad. And we can talk about all of them. And the other one, who's the real celebrity in this room, is Ido, who said it's not broken, it's just young. So let's also keep in mind that our ecosystem is extremely young. 10 years ago, it was about 30 deals per year. Now it is more than 500 deals per year. We are far from the 50-year-old US VC ecosystem that we want to look like. So we have time. We need time.
Okay, so what I hear, pretty much everybody looked at the Silicon Valley and did something similar with local tweaks. And anywhere you go, like India, China, Latin America, and whatnot. So then the next question, And I'll pick on Fatoumata for that. So what do you think worked well and what didn't work well in that, if transplanting the model, what are good things that worked out, what didn't work out as well?
Well, if we take a step back, so as I mentioned earlier, we've been investing across 2 funds. We made now more than 30 investments and have 4 exits. So when we look at what worked well, so another interesting debate usually is opposing actually commercial returns and impact, right? And to me, it's really something that's quite surprising as a debate because my experience, both as a former operator myself from co-founding a company to an IPO, and most importantly as an investor, is not only they go hand in hand, but in Africa, when you unlock access, whether it is to essential services, to products, to content, when you unlock access for SMEs, when you create jobs, most importantly for women and young people, actually commercial returns follow. So, for instance, at the macro level, I'm sure you all know that we have the highest rate of female entrepreneurs in Africa at 26%. Yet we have a $42 billion funding gap. And beyond the moral case, you actually have a business case. So for instance, you have McKinsey studies showing that if you bridge that gap, you can unlock 10 times the GDP of Senegal extra, so $300 billion extra. So that informed part of our thesis. So today we have more than 50% of our portfolio companies that are led by female founders or co-founders. And when you look at what we are doing, actually, the intention matters, but I would like to talk about some learnings as well. So when we look at about on the follow-on capital raised overall, so the average follow-on capital raised by our portfolio is €3 for every €1 we invest. So there is catalytic pipeline. But for female founders, it's actually 3.8 euros that they raise for every euro that we invest. And more excitingly, I was talking about some exciting exits that we started to have with our pilot fund, so which was 11 investments that we made actually across Africa. One exit we had, for instance, was in Tunisia, where we backed a fintech that was born from a Tunisian actually engineer like Tidjane, who actually expanded it to Europe, and we were able to back them for 6 years. And to make roughly a 4x return in those 6 years, 13x on the seed ticket and 2x on the Series B ticket. When we were the first African VC on their cap table, and when we invested, they were not even doing 1 million ARR, and it translated into a 100 million exit to a Swedish unicorn. Similarly, we invested in Egypt as well, in a car classifieds marketplace that was really solving a trust issue to be able to access affordable quality cars, with over 2 million Egyptians trusting them on the platform. And similarly, in less than 4 years, we were able to exit full cash sale to Dubizel, which is a unicorn based in the Middle East that is now actually contemplating an IPO, right? So these fundamentals show that you don't have to choose between performance and impact in Africa. And for us, it really goes hand in hand. And we hope to be able to walk the talk next exits as well.
So this is interesting, right? Because when we talk about Africa, you often hear impact investment and a lot more than you would say you would hear in Silicon Valley. In the Silicon Valley, they will tell you we're changing the world, and that's really the buzzword, right? It's greed, and the change in the world comes as a function, as a consequence of that greed, and that's great. Don't take me wrong. Like nothing's wrong with greed, and nothing's wrong with changing the world. But when people talk about Africa and impact investing, and investing in women business is a little different, but it's still women entrepreneurs. It's a different take on impact investment. So I'll ask Mohammed, right? Because this is the development. So when you what do you think? Are you about how do you view Africa? Is it about making money, or is it about building the ecosystem? What's it for you as an LP in this fund, or a direct investor as well?
So this is a good question, and I get this question a lot. We believe that impact starts with returns. We will never back a fund purely for impact. When we consider a fund or a direct investment opportunity, we have to meet two standards. One, does it make commercial returns? And two, does it have an impact story? So we have an extra layer of responsibility to achieve both whenever we make an investment. The reason we do it is because we believe that to make an impact, you have to invest in sustainable businesses and funds that continue and survive. And the only way you do that is they're commercially sustainable. So when we look at the market and we think about Africa, the opportunity to make an impact and to generate returns is high. Now, Africa does have some structural challenges, but once upon a time, by the way, the venture capital business in the US suffered from very similar challenges. They didn't have exits. Funding was very, very difficult. What was different in the US was the amount of R&D centers, right? The government was spending a lot. The Department of Defense was a heavy, subsidizer of research in universities. We don't have that in Africa, right? So Tidjane made a very important point, which is where are we in the story of the development of VC in Africa? It's super early, right? A lot of the problems you're seeing today are because, one, we came out of the COVID bubble. And let's be honest, during COVID, everybody was punch drunk. There was no due diligence. Investors were careless. We gave entrepreneurs the wrong advice of how to build companies, and we're coming out of that, right? So I think that one gap that Africa still has to solve, and we are trying to do our best to sort of solve it, is we have to have an exit story, an exit IPO market. If you had that in Africa today, you would see Flutterwave go public, you would see Moneypoint go public, and you could actually point and say the asset class works. Today, we have a strange dynamic where we have a lot of funds and a lot of companies who have high TVPI and low DPI, right? And that's not a healthy situation for the future. But it's not because there's something structurally wrong with Africa. It's just because we don't have an exit story, an exit path. If we can solve that, you'll see a lot more capital rush into the market because everybody from the outside, by the way, looks at Africa and says, population is growing, the future is here. So dynamics are in the right direction. It's just missing a couple of things that we have to fix, and then you're off to the races.
Okay, two things to fix. Or more than two, but there are two big things to fix. One is exits. If I heard correctly, IPO, sales, M&A, and the second one is LP mix, right? Where you get the how do you get the LPs to pour money into the funds that would make it? So now, Sapna, it's your turn because I picked on everybody else but you. So and you get two questions as a bonus. So what do you think? Question number one, do you agree? And question number two, how can we get LPs invest? Not just development institutions like true commercial LPs, and how we can generate exits.
Okay, let me start with the first one. And I think we're all aligned. This ecosystem is still very young. There are signs that it is maturing. But when we started at Novastar in 2014, there's not a lot of sort of data. I think Partech has been great in sort of sharing this data. There's probably about $400 million of investment that was going into the VC ecosystem on the continent. And that was sort of early stage VCs, angels, family foundations, and philanthropic capital, the acumens of the world. Last year, it was probably about 4 billion. So 10x in just over 10 years. So this is not as fast as what we've seen elsewhere in India and China, but this is a really good sign that there is a growing sort of capital base that is coming into the continent. It's not enough, but it's growing. The early venture funds received a lot of capital from development finance institutions, from DFIs, mostly in Europe. And that was really essential to sort of catalyze and take that risk on a VC asset class that was so early, maybe just a few years old at the time. And that enabled sort of the VCs to sort of get up, start running, and also institutionalize. What we're now seeing is that because the ecosystem is growing, there are signs of exit. Maybe they're not talked about enough, but there are signs of exit. There is more interest from private capital and larger sort of institutions of private capital. So with Fund 3, Novastar has raised about a third of our capital. This is a $147 million fund from private investors. Fund 1 was predominantly development finance institutions. So that is the sort of trajectory that this ecosystem needs to move in. And why is this private capital interested? It's starting to see that actually there are synergies with some of the companies that we're investing in. This private capital, especially institutional capital, corporates, are saying, ooh, we don't have access to this innovation that you guys have access to. You're seeing what some of the most interesting things on the continent, what's happening, whether it be e-mobility, fintech, clean tech. And so we want access to that. And that's us investing in the funds is a way for us to see it. So I think we're on the right track. Exits, Leo, your question on that, it's still early. We absolutely, Mohammed, need an IPO market, but we're starting to see some of the sort of trade investors acquiring businesses that we've invested in. We thought that there would be a lot more trade investors buying some of our companies. And so actually one of the learnings is that there are opportunities for secondary exits as well. So exiting into funds that are coming in at a growth stage. That was not something that we thought we'd be doing when we first set up at Novastar. But there is now a bit of a market for that. So again, that's signs that this market is starting to grow up. I think what's needed in terms of the next stage is secondary funds. So who is actually buying stakes in the LPs that are coming to the end of their life, fund life? Because we do have a model, whether it's right or wrong, in the VC space here mostly, that is a 10-year +1+1, maybe a few more years structure. And the companies that we're investing in are going to take a lot longer to scale. And so there needs to be options of how do you extend that. So I think we're starting to see some of that as well.
So the secondaries is all the hype now so again, exploring the model, right? It's in the United States, they're different in Europe, different kind of their secondary funds. They're like, people buying family offices, buying secondaries, and their platforms people can trade it. What do you see in Africa in terms of secondaries? Is it too early?
We're starting to see later stage funds buy secondary stakes from earlier stage funds in the underlying companies. So that's a start. And we're starting to see some secondary investors buy stakes in funds. So for example, Blue Earth is starting to come into the market as a secondary fund. And I hear that there's a few continuation funds that are being set up now as well. So early days.
I think it's part of the solution, but it's a Band-Aid. I think the people who are buying secondaries, it's not a bad idea, but they also have to underwrite their own exit, right? So I'm saying all of these things we have to do to support the asset class, but ultimately you still need to solve the IPO story because you are seeing PE funds being buyers, you are seeing trade sales, the secondaries funds make a lot of sense, they'll have a role to play. But to really unlock this market, we need to have, Africa needs an IPO story, right? So an IPO market. And I think, we need to encourage governments to start thinking about this, whether it's Nigeria or South Africa or Egypt, to really target and really to create a pathway for tech companies to go public. So thinking about what's the criteria to go public, what are the requirements. When you talk to any investor or the capital markets folks in Africa, they think real estate, right? Industrial. They think dividend-paying companies, right? So we need to have a different asset class, different requirements, different governance standards to enable these companies to go public, because ultimately that's going to unlock the global investors to come into Africa in a big way, right? And our role as a DFI, we feel very proud when founders or funds that we back graduate and don't need us. We've done our job. Right? So they can go off and raise money and private capital comes in. If we can anchor and mobilize capital into the ecosystem, we've done our job.
I would like to come back quickly on three things. One is the nature of the funding that we've seen in the VC space. So as you mentioned, we did tenfold in 10 years. But what was quite different is, like 10 years ago, it was mainly equity. Last year, it was a mix of actually equity and venture debt, which also speaks to the nature of the businesses that investors are looking at. And I think maybe 10 years ago, just a narrative of a high growth, high burn would work. And now we are all looking also for a better path to profitability, better capital efficiency, both as equity investors. And that's where you see, I think, this massive increase in also, recurring business model that have cash flows and that can also absorb the venture debt. That's one mega trend I wanted to highlight. Two, on the question of who is missing around the table, like Sapna and Novastar, we also, for the fund two, were quite intentional about bringing private capital alongside the DFI that has trusted us, as well as MEDA. So we, for instance, were able to attract founding partners of KKR and also billion-dollar companies that were coming from Germany, exactly with an idea to be able to build kind of a strategic M&A pipeline for them and have also this built-in path to exit, hopefully for a few of our companies that will be fitting the exit strategy. But I think the elephant in the room when we look at who is missing around the table. So globally, when you look at VC funding, for instance, institutional capital, for global pension funds, insurers, banks are a key player. They usually invest between 15 and 25% of the VC funding globally. And in Africa, they still sit on, I would say, $1 trillion of assets, but I only allocate 3% to both PE and VC included. So that's really one, I think, also opportunity for us somehow, where also policy can help. When you look at Egypt, for instance, it's when the central bank had incentive for the local bank to invest in VC that you saw Sawari raised fund two with actually almost $35 million coming from 4 local banks in EGP, which also help with the currency hedging. We need to see more of that institutional money, whether it is international or local. More corporate as well, because, DFIs are here and we love them to play a catalytic role, and they are not catalytic anymore if they are the bulk of the money, and we need to attract others. And I think one way to do so is de-risking. And what we've seen, for instance, is we're able to have a first loss equity piece in our fund. And from securing that, we're able to attract more of these players that I mentioned, but also endowment of African universities, like people that we will not usually see on our LP base. And I would like to come back also quickly on exits. So as you mentioned, of course, we need IPOs. Maybe in our fund across the 30+ investment we made, we hope to have 1 or 2. And there are places where we already see IPO activity. Last year, for instance, in Morocco or in South Africa, it was not necessarily tech businesses, but it was definitely groundbreaking IPOs. But you also have really trade sales to M&A players. And it's, to me personally, it's really the main route. And out of the 4 exits we executed so far, 3 are actually strategic sales to a strategic player. And as you also mentioned, secondary is a mega trend. We see roughly 20 to 30% of exits globally done in secondary. In Africa, it's a lot GP to GP. And it's not closed yet, so finger crossed, but we are expecting to welcome a major, large global secondary player as well in our LP base in the next few weeks. So hopefully this will also help. I think there is no one size fits all when it comes to exits. IPO will help build the story and attract more global players, but I really believe in trade sale to both strategic and financial buyers and more secondaries, as Sapna mentioned.
Yeah, thank you. I'll just touch on something. There's a lot of sovereign money sitting on the sidelines, whether as a could be poured as just basically into funds or accelerators just to build ecosystem, as you see in other markets. I mean, that's a total different story, and it's a policy kind of decisions for the governments, kind of other than lobbying, kind of little we can do about that. One thing that, again, one theme that I heard is that it's a young ecosystem, and I think it's also an unlucky ecosystem because it peaked at the peak of the 2019, 2001, when people were just spraying money everywhere. And then it crashed, and it hasn't, with the rest of the VC market. VC market crashed globally and hasn't recovered. So a question for you, Tidjane. If you and the answer is I wouldn't spend any money is not allowed. If you were going back and had to invest the money at the peak of the market back then in African markets, what would you do differently, and what would you do? Not investing is not an acceptable answer.
It's okay. I'm very comfortable with that answer. First, because I actually didn't invest, and I would go back and invest. We didn't deploy nearly in those 2 years. It was our lowest years at Partech Africa. And I will say two things. If I was to go back, maybe what I would have done different is every VC in this room, we should have done a bit more liquidity when everything was high, right? Sell a bit more. I think I still would have invested as much in the same companies. I don't think we should sit here living on regrets. Valuations were high, but the amount of money invested in the ecosystem at the peak was $6 billion. We're still deploying $4 billion a year. We haven't crashed. $6 billion is still way too low for the whole continent. We should have invested 12 or 20. What we should be asking is, at the peak, when capital was very available, in my opinion, we didn't distribute it in enough companies. It was very concentrated, and by the way, it is getting more and more concentrated. We're still growing, but we're investing in less and less companies. Again, ultimately, the game for me on VC is to make sure we have as many talented entrepreneurs going around with enough capital to at least validate what they're trying to do. And so deploying it in multiple assets instead of what everybody did back then was, there are a lot of mega deals. A lot of people raised $100 million rounds. And the good news, by the way, is, and we were talking about this in our report this year, if you look at the round distribution, last year, it was the flatter it's ever been. It was more evenly distributed, which means it was given to more people, I won't say fairly, it's not fair, more equally, and given an opportunity to work. I think if I have one regret again from the peak is we should have done more. We should have given more money to more startups to try when failure was more accepted. Today, a lot of really good entrepreneurs out there are being barred from trying because we're all sitting here now asking them about profitability. Who is Series A investing in this room? Come on. Don't be shy. Series A investing? Series A. Okay. Who hasn't changed your policy on profitability when you invest? We all are trying to become Series B or Series C investors. I think that's one problem. Second problem, to come back to the secondary, because I promised to disagree on something and create drama. So I disagree with my boss sitting here.
We agreed before this panel.
Right? Secondary is a band-aid. It isn't. What is it? Series A investors again. Who's done secondaries in your Series A and B rounds? Three brave hands. And what is the pre-seed investors? Please raise your hand. Pre-seed and seed. Where are you going to get the liquidity from if you don't do secondaries? Secondary is an important way to recycle back the money into pre-seed and seed. And for them, for Grégoire here, for these guys, it isn't a band-aid. It is a lifeline. And if we don't do it, we're killing the early stage that is feeding us all. So yay to secondaries. Pick the side, please.
Okay,
Right.
the timer I respect, and we have a few minutes for questions from the audience.
Give him a chance to fight.
Okay, I'm giving a chance to fight back.
Can you please replay the tape? I said it is a good idea, but it's a band-aid. I didn't say it was a bad idea. No, look, I mean, when we, even for IFC, so we do have the luxury, I'd say, privilege of having capital, right? But whenever we invest in a startup, at every funding round, when the company is raising money, we ask ourselves, are we a buyer or seller? And we sell aggressively, right? So we even for us, right, we want to make sure that our investment portfolio generates returns. So we actually have to generate returns for IFC, right? So they measure us on returns and they ask us, what's the valuation? When are you going to exit? So we have that discipline. We have the same pressure, right? So I'm not against secondaries. I just think that it's a step in the right direction, but not the full solution.
Thank you. All right. So a question. Now we can take questions, please.
Thank you. Hi, my name is Dr. Ola Brown from HealthCap, and my question is actually centered on the secondaries debate here.
It's yours.
So, Lexington Partners, probably the biggest secondaries fund in America, raised $10 billion for secondaries. Hamilton Lane, $6 billion. Harborvest, $6 billion secondaries fund. Stepstone has been acquiring other smaller secondaries funds and has come into a mega secondaries fund, again, $8 billion under management. So altogether, there's now the Chicago Secondaries Conference that even primaries are not allowed to attend, and there's 1,000 people there, all on secondaries. So my question is, are secondaries actually sort of a band-aid or a sign of a broken system, and America is getting it completely wrong and they're doing something that is unsustainable and it's going to come and bite them in the future? And we've seen this in America before, during the global financial crisis, where, they were piling on these securities and everybody was buying them, and the effects of that financial engineering actually, reverberated around the world. So is it that they're getting it wrong and we're actually getting it right by being more conservative and trying to push our companies to IPO or trade sale? Or is Africa just slow and this is something that we should have even embraced before America?
So I would say secondary, especially if in developed markets, is a sign of just a sophisticated market. Everybody has different timelines for exit, return expectations. People have different needs of capital. They allocate capital based on what's available for them. So sometimes they want to sell a fund because they have a better investment. So to me, it's just a financial instrument designed for a market where it provides transparency or a clearing price for the asset. So again, for Africa, it's not a bad idea. And I think there's a lot of demand for secondaries. I mean, you just look at the unicorns in Africa right now, right? There's a lot of trapped investors. Right? There's a lot of TVPI that's looking for an exit, right? So we do need secondaries, but I think it's a step, right? So I really think that for Africa, it's unacceptable for us not to have an IPO market. That's just it's not sustainable, right? At the end, and I think there's some discussions already where governments have started to realize that this is a potential problem, and we need to think about how to do it. So. Guys, we sell from round to round, right? And we're a DFI, right? So we have the same exact pressure to make sure that we make investments that generate returns. So we're really, on that dimension, we have similar constraints from our investment committee.
All right, thanks. My name is Joy San Wanaina. I'm with Chui Ventures. Which is a Pan-African seed fund that invests with a gender equity lens. So as you can imagine, I'm going to point this at Fatoumata. I was really impressed with your presentation and the fact that you have had amazing outcomes. You've invested 50% of your capital in female founders?
56% for Fund 1, yes.
Wow. in female founders, and yes, I clapped. And the reason I clapped is because we are aspiring. We've done 44%, but it was really in the reaction. There's a sense that investing in female founders is an impact only idea and not a commercial one. And yet, I'm sure. I mean, our experience has been that the top 5 investments we have made, 4 out of 5, the fastest growing are female founders or co-founders. I'd like to know from your experience, and how do we retell this story so that it is not that, you know, investing in female founders is an impact story, it's a commercial one. And are we telling this story well? And how can we tell the story better?
You're very right. And that's why I started with the business case. You know, for instance, even globally, that's quite true. So you have some evidence that show that overall you have, I would say, $68 to a cent return for female founders, and it's $31 to a cent return for male founders. Actually, you know, talking about that narrative and coming together to have a platform about the business case and not about inclusion only. For the past 4 years in Davos, I've been gathering a group of female unicorn founders globally. Overall, you have 1,200 unicorn founders and 120 are female-led, and I gather between 10 and 12, which is a big size of the cohort, sadly, to make actually this business case known. And there are so many studies. I think even AVCA has studies showing that whether it is at founder level, but also at fund manager level, when you have a diverse fund management team, you usually have better outcome, better IRR, and it's consistent. And it's the same. McKinsey has a study called Women Matters that has been running for more than a decade that shows the same at board level. So I think if we keep really sharing the evidence first, and, you know, speaking back at Leo and not talking about only inclusion or, you know, I'm not a charity investor. You know, whatever I made from, with Sebastian and others from Junior IPO is fully invested in what we do, and it's risk capital. My wealth manager always tells me, what are you doing? Go buy buildings, and I'm here investing in these female founders and also their male counterparts. It's because we believe in it, and that's why we're so intentional about exits, early exits. And we will keep hopefully focusing on that. Sometimes it will be smaller ones. Hopefully one IPO to make Mohammed, AVCA, and the ecosystem proud. But that's why I also like these zebras and antelopes, you know. So far our exits have been 100 million, roughly. And we have 1 or 2 candidates, hopefully for an IPO. Actually, the largest one is female-led. So let's see. Hopefully we help them get there.
Yeah, last question.
Good morning, everyone. My name is Anu Balogun, and I work for Laniwa Ajayi, a full-service commercial law firm headquarters in Lagos, Nigeria. So we support VC funds throughout the complete cycle of the ecosystem. But my question, well, I have a comment as well as a question. And my comment is regarding what Mohammed said about African governments doing a lot of actually shaping policy to support IPOing VC-backed businesses. As far back as 2022 in Nigeria, the Nigerian government, the NGX, the Securities and Exchange Commission, took a deliberate decision to establish the Tech Listing Board. And this is 2026. We've seen very few companies come to list. I'm sure, as everyone is aware, Flutterwave is trying to. There's still a conversation around whether to list in Nigeria or to list in Delaware and things around those. So for me, the question really is, some African governments or some African regulators in the ecosystem have done quite a bit to foster, to drive along that conversation. Why aren't we seeing tech companies come to the market? Because yes, you've said a lot about governments need to do more, and they are doing more, at least in Nigeria from where I come from. Why aren't we seeing the IPOs happening in the ecosystem? Thank you.
Yeah, it's a great question. And I think the answer is because then they don't really understand what all the things they need to do to make it feasible for these companies to list. So simple questions, right? What are the KPIs that the company needs to achieve? What's their revenue? Does it need to be profitable? Does it need 3-year audits? Who are the anchor investors? So you still need a pre-IPO fund to anchor that. And then once you list, where's the liquidity going to come from? Where's the market research, right? You still need coverage for the asset class. So the decision or all the things that you need to put together in the ecosystem for an exchange are extensive, right? So it's not just a matter of like, we want this to be an IPO market. There's so many things you have to like execute on, from governance, accounting, audits, liquidity, institutional investors, anchor investors, and to put that together is not trivial, right? So to me, I just look at it and say, there's a sign, there's an opening that says, hey, we want to do this. So now as IFC, we have to play our role to say, okay, how can we convene the right stakeholders to sort of put this together, because we care about the ecosystem, we care about the exit. And if we execute on this, I think it's going to benefit everybody.
Maybe two learnings from other ecosystems. One is the region in the world where you have the highest rate of exit through IPO is India, 60 to 7%. It doesn't happen overnight. They actually have two compartments for SMEs, including tech, on the two largest stock exchanges, and they graduate. So at first you had 500, for instance, on Mumbai, and for some of them actually graduated to the main compartment after the IPO. And two is maybe pre-IPO funds that really help actually build that liquidity, that governance. Like my largest company, we spoke with London Stock Exchange to know, okay, what's the size of the business that should attract an interesting listing, what's the level of profitability expected. But it's not something that can come only from us GPs or LPs here. It's an ecosystem drive.
Thank you very much. This is all the time we had. We need to run this thing on time. Mr. Sebastian Sawe ran London Marathon for under 2 hours yesterday. Give it up for him. And he can do it. We should be able to do it on time too. Thank you very much. Give it up for the panel.
You guys.
Thank you.